Hey, what's up, again, Moose? Mike for the Moose on the loose. Happy Monday. All right, so another week, another all-time high. It's pretty much how it works, right, guys? We are in a 3 consecutive years of double-digit returns. Kind of crazy, but with a market that is a all-time high, comes with a lot of like red-hot stocks, like those companies, those stocks that are never going down. What's happening with them? Are they invincible? Is this like your like fast track to retirement to like double digit returns forever? What to do with them? Should you buy more, hold them forever, let them run, or sell them, cash your profit and run, because we're gonna head into a correction anytime soon, right? So this is what we're gonna talk about today: how to handle those red hot stocks, going from a buy perspective, so you don't have it, it's on your radar, and you're hesitant to pull the trigger, on the point where you have them in your portfolio, so should you hold on to them and let them run? And finally, if you should sell, trim a little bit, cash your profit, take the money on the house, type of thing. But first, we have to go back a little here and talk about why the stock price is up. Like, what's happening with this company, and what drives the all-time high price. So first, all-time high. The all-time high price is really just price anchor in the price anchor bias in disguise. It's nothing else. You look at a chart, you have like a 1 year, 5 years, whatever chart, and then you're just like, yeah, this stock has never traded at a highest, and here's the kicker, you're going to say highest valuation, which is maybe not true, but highest price. So that's the first thing. It's the highest price today. I mean, go back in time and you'll see that the highest price for all those, like all the Canadian banks, were a lot lower in 2019, but still they were at the highest price, highest point ever. So was it a good time to buy them at 2018? 2019? I mean, yes, probably. I mean, of course, you could have waited until to have COVID happen, because everybody knew that in 2019, that a year from now, we're going to have like a pandemic. That's, of course, something that we all knew. But imagine that. I mean, buying banks in 2019, you would have made a killing, right? So again, same thing. All-time high, stock with price anchor bias. So why a stock is moving up, instead of like looking at the price anchoring, maybe it's going to continue this way for the next 5, 10, 15 years. You don't want to miss on those opportunities, right? So why a stock price goes up? For two reasons. Like it's very simple when you think about that. One reason, the one that I prefer actually, is earnings. The company makes more money and more money and more money. Well, it's only normal that the stock price, the value of the business, increases over time. The second thing is the narrative. And the narrative, I mean, this is where we get those funky stories of like your neighbors that put like $50,000 in Tesla in 2017, and he's like now has 10 Tesla in his garage. And that's the narrative. And the narrative could be right, but could be wrong as well. So let's do a deep dive into the narrative now, and then we're going to talk about earnings growth. So the narrative, I think, sometimes in the red flag. So this is a business that has potential. There is a good story. The financial analysts or people around the stock will tell you this company is going to grow. It's going to break it through. The problem is, if you don't have a thriving business already, it's really hard to justify this. And this is where you're going to see those big jump and then big drops. I got caught in the past in those. I try to avoid them today, and I prefer to have a great narrative with great metrics. Because if you only have the narrative, that means that you're paying more for something that you don't know if it's going to be worth it or not. So this is where the valuation is going to increase. We call that PE expansion. So you used to pay a stock at a PE ratio at like 20, and now it's at 35. Well, you're paying a lot more for each of those shares before compared to what you used to before. So when earnings per share are growing year after year, it's only normal to see the stock price following along. So if over the past 10 years, the company grew their EPS by 10% annually, well, then you could expect a stock that goes up 10% annually as well. It's only normal. Then you're just paying the same valuation, the same multiple over time. When you get there, the question is, why is it growing and will it continue? So, for example, Dollarama has been red hot for so many years, trading at a high P ratio. But when you think about that, the company is growing by opening new stores and improving their margin in existing stores. That's great. So they can continue to do that. They have a plan to open new stores, still working. On top of that, they are also growing by acquisition. So they're using the same playbook in Central America, in Latin America, and now recently opened a few stores through Dollar City into Mexico. So here's another way to grow. And they add a third way to grow by acquiring the reject shop in Australia and trying to do the same playbook over there. Will it work or not? That is yet to be seen. But overall, Dollarama has plenty of growth vectors. The stores in Canada, improving the margin, expansion through Dollar City, expansion in Australia, to continue the same narrative. So if the numbers are working and the narrative is working, well, then you're kind of like moving towards the right direction. If you want to find more companies like Dollarama and companies that have a strong dividend triangle, you can subscribe to the Moose Markets newsletter. So moosemarkets.com/newsletter. So moosemarkets.com/newsletter. And every Friday, you're going to receive a lot of information about investing and to stay on par with your strategy. All right. So now let's close out this show with what to do: buy, hold, or sell. To buy, super easy. You have a strong narrative, you have a strong investment thesis, you have strong metrics. Now, if you're not too sure to pull the trigger and you don't want to overpay for it, look at the average PE ratio over the past 5 years, the average yield over the past 5 years. So those are like two metrics versus the current valuation. For Dollarama, for example, that has been trading roughly at the same P ratio for the past 5 years. So if you're buying today, you're not paying more. I mean, it's expensive, but you're not paying more. Now, keep in mind though, it is priced for perfection. When you're going for a stock that is trading at above P ratio of 30 times the earnings, well, then of course you buy it and think in decades. Because if you go into the stock right now and now they start to have like some bad news, the stock price is going to drop double digit. That's for sure. We've seen that in the past so many times. You have to be careful with that. So yes, you could wait for this to happen. Not always happening. So I prefer personally, that's me, that's not you, that's not financial advice. I prefer, once I have a strong investment thesis and strong metrics, I go in, especially if the company trades at about the same P ratio and same yield over the past 5 years. So when I do that, I know that it is possible in the next 2 years that the company stock is going to drop or going to be dead money for 2 years. I don't care. I'm thinking in decades. So I don't care about what's going to be the stock price next January. I'm thinking about next January 2035, right? So that's for the buy side. For the hold side, you have it in your portfolio, you're super happy. A lot of investors will have this like those rules like, oh, I sell after 25% profit, 50% profit, even 100% profit. And they're thinking, yeah, I'm now running on the house money. Yes, but you leave a lot of money on the table. I mean, you finally got a winner. You did your research. You know what you own and why you own it. And then it's working. Why would you not let that winner run so much longer? I mean, I would kick myself if I would have sold my Apple shares after 100% profit. I'm like at 1,500% profit, 1,500% profit. Same thing for Microsoft. I'm like probably like 500 or 600% profit. And a lot of my holdings, my best performers, my largest positions are showing more than 100% profit. Why would I given up so much money on the table? So instead, I just make sure that the investment thesis is backed by numbers and that the numbers are still good. As long as the numbers are good, it's going to continue to run. Then the last part, if you should sell. I prefer to sell in terms of exposure to risk. So I will let my winners run kind of like forever until one of those winners become too big in my portfolio. And then you just determine like what's your maximum weight on one stock. It could be 15%, 20%, 10%, 5%. It depends on people. The point is you have your limit. It goes above the limit, you trim a little bit. So my limit is 10%. So I trimmed several stocks in the past. It goes up to 12. I bring it down to 8. So I still have 8% of my portfolio into one stock, and it's going to do well, hopefully. But if I'm wrong, I cash some profit out of it, and that's how I do it. So to buy strong metrics, strong thesis in line with the average P ratio, boom, I'm in. For old, well, as long as the metrics will match my investment thesis, I'm going to let them run forever. And I'm going to sell just if it's too big in my portfolio or if metrics or the investment thesis is not right anymore. So at one point, maybe you're going to say, well, it's not growing anymore. Well, it's time to get rid of it and then move on to another one. So again, if you want if you want to have more tips like this, you can register to my weekly newsletter at moosemarkets.com/newsletter. So it's moosemarkets.com/newsletter. We're going to talk again tomorrow, and tomorrow it's the battle of the big utilities. We're going to take a look at Fortis versus Hydro One. All right, until then, don't forget to stay invested.